Gary Tignanelli with our latest client update, February 23rd. We sent one out in writing on Friday. You got bullet points of what we're thinking about, and then you got a written dialogue, and at the end of that there were some of the points about the stimulus plan that we felt would most impact our specific clients, some things that you could potentially benefit from in the stimulus package. So you can look that over if you want some more details on that, but this video is just to give you our person-to-person report as to what we're thinking about and what we're attempting to accomplish right now in these markets. I've got Tim Maurer with me, our Director of Financial Planning, and I was going to have Chuck Bender with us today, the investment team leader, but this is not a time for, or I should say, this is a time that a lot of people are not feeling well.
Yeah, literally.
And so Chuck wasn't able to make it with us today. And I apologize for the fact that these videos tend to be relatively crude in the sense of how we put them together. That they're not more quote-unquote professional, but we don't intend to try to do that because our objective is to quickly get out our thoughts and feelings to you in the most expeditious manner possible. With that said, the first thing I wanted to address, Tim, is that we're still in a deflationary spiral.
Right.
Asset prices are coming down.
Right.
And so that means real estate's coming down, stock markets are coming down, commodities are coming down. So that's a concern that we still currently have. But we think there's good news.
Yeah.
Why do we say that?
Well, because this whole notion of capitulation means both a beginning and an end. And so we think that there could be signs of an uptick at some point in the relative near future, maybe even a significant upward move. What we don't know and what we fear is that that move may start significantly lower than the market sits today.
It's already, when we first started to put this together, the market was at 7,800 and
right.
now it's at 7,300.
Sure.
We anticipated a break of the lows back in November of 2008 when the markets were at 7,500 then. We expected that this market could easily go to 6,500, and it looks like that's pretty much the target that we're still able to get there. Now, the point is, it's still a dangerous market,
yeah.
But there's reason to be optimistic that you're going to have a good up move. And one of the things is we've looked at the concept of a market making significant quarter-by-quarter declines.
Right.
And it just doesn't happen very much.
Double-digit declines over 2-3 quarters, is that what you're talking
Yeah,
about?
and we had that in last quarter.
Right.
What was it down that quarter? About 25-30%
Right.
In that quarter.
That was a rough one.
Yeah, and then this quarter it looks like we'll easily do a double-digit decline,
Right.
unless something dramatically improves between
Sure.
now and the end of this quarter.
Sure.
So, you know, you put the statistical, and I've looked at the U.S. Great Depression, I've
Right.
looked at the 70s U.S. market, looked at Japan in the 90s, I've looked at the Hang Seng, and in the late 98, and I cannot find 3 double-digit quarterly declines.
Right. Even through the Great Depression, right?
Even through the Great Depression. So I think that now this market does have a history of
Right.
breaking historical
Yes,
precedences
indeed it
too. So that's one thing I think that we got to keep in mind. That's why we're being relatively conservative still.
Right. Right. We do see the optimism on the horizon, but at this point it's still enough of a risk that things could go significantly lower that we're not willing to put too much our clients' exposure into equities, right?
Absolutely. And we think that commodities still have a tremendous upside potential.
Right.
The supply and demand, I know all the stories are, you know, that demand is collapsing around the world and things of that sort, but I just don't see it. There's a great destocking that took place.
Right.
You know, people were buying commodities to try to participate in the up move,
Sure.
and now they're selling them off. So you've got a great supply due to the destocking, but the supply and demand and the ability of of the world to produce commodities is still dramatically below the need.
No question. And some of the horrible news that we've heard throughout the last few months has been about people losing their jobs. And this is a sad and rough thing for people to deal with. But at the same time, these companies are actually becoming leaner and meaner so that when they have the opportunity to get the debt that they need, the leverage that they need, they may be in a better position than they were 3-6 months ago.
And that's one of the differences between today's stock market and 4 or 5 months ago, is that the bond market has actually been much healthier than it was back then.
Right.
In November of last year, the interest rates in the bonds and the credit markets were totally seized up.
Sure.
It's not true right now. The bond market is acting fairly healthy. It's not healthy as it's been in the past, but it is fairly healthy.
Yeah, didn't even our buddy Warren Buffett sell some stocks, some big blue chippers the other day and buy some bonds?
There's been a lot of money flowing into the investment grade and even the high yield junk bond market. A big Japanese bank just generated over like $4 or $5 billion of loans. Roche company did an acquisition recently where they were able to get billions of dollars, $16 billion to do an acquisition. The bond market is acting much healthier than
Sure.
it was 4 or 5 months ago, and the governments around the world appear as if they're committed to just doing what they have to keep bad banks from creating a major problem in the economic system. As long as they're willing to print the money and to nationalize these things that need to be nationalized, I just don't see it as a tremendous risk at this point in time.
So we think there's an opportunity for growth in the relative nature, but it seems to me that what you're saying is there's also then the potential for something that could be even more cataclysmic at some point in the future?
Oh, I think that there's no doubt that you have to keep your eyes on these exit doors over the next 5 to 10 years.
Okay.
That you've transferred the risk from the individuals of the markets to the risk to the taxpayers of governments around the world. Whereas instead of people who made bad investments without proper risk management, taking their losses, they've been transferring that to the taxpayers. The bank's bad debt, Fannie Mae's and Freddie Mac's bad debt, all these were not the taxpayers' responsibilities, but government saying we're going to take them on because the results would be too cataclysmic.
Sure.
And so I do believe that there's a major day of reckoning coming in the distant future.
Well, but there are some countries that are in better shape than others, right? I mean, we don't think necessarily that the U.S. is going to be the beneficiary of a lot of this stuff that's happening, that they could be the ones struggling down the road. What are some of the countries that we think are going to be in a stronger position?
When the U.S. was in a major bull market in the 90s, Japan was in a major bear market.
Right.
When Hong Kong and China were in a major bear market in 98 through 2005, the U.S. had gone through its little bear market cycle and was in a major bull market.
Sure.
So you have these situations where countries can diverge, and it appears to me that Asia is diverging from the U.S. And look, if the U.S. does well, Asia has to do better.
Right.
If U.S. does poorly, Asia doesn't have to do poorly. But even if Asia does poorly, it's already starting at a lower low than the U.S. The
Sure.
Asian markets last year were down 5 to 6%, and the U.S. last year was only down 33%, and now it's only down about 10 or 12%. So there's still a big differential between the two.
Sure.
So I think you've got a incredible opportunity still in commodities, still in China. We're not going to get carried away with it. We do believe that there's an opportunity. So that's what we're looking at. We increase our equity exposure. We increase our equity exposure. For now, I think we're in a very good place. Tim, I think that pretty much wraps up where we're looking at, and we want to thank you for your support of the Financial Consulate, what we're trying to do. And for any questions, feel free to give us a call. This is Drew Tignanelli. God bless.